We're early in calling for 27.50 fair value. You still think the Fed needs to cut at least a couple of times. You're looking for earnings to come down to your 156. Is this all coming your way?
It did. However, one of the things that happened on Monday is that Powell pivoted yet again. And when he did, he simply reiterated and affirmed what the market already expected, which was a rate cut. But by doing so, what he did is he added about a half a turn to the PE. Instead of 17.5, I could see 18 times. And if you take half of a year's earnings, that 80-point move describes the first 2.5 days of this week. So right. He essentially moved the market's fair value up to 2,800.
Barry, his quote was that the Fed would act appropriately amid various trade issues. Where do you hear the words rate cut in that?
Well, when you just heard the president talking next to that helicopter, that sound, what he was basically saying is that tariffs are a tool that they intend to use, and they don't expect any quick deals. The economy is already weakening. We're seeing the low inflation in the most recent releases. And as a consequence of that, I think the odds are that they will cut by year end as the futures expect. We
were talking before the show, Mike, about cut cycles. Right. And how stocks usually don't bottom until that cycle's done.
Right. I mean, right now, from this level where the market is and the way that the yield curve looks, implying that there should or will be, one or two cuts, but then the world will be okay again because then the yields further out look higher. That's the structure, the implied message of that rate structure. That's kind of threading the needle. That's sort of saying this is going to be the exception to the rule of, one or two cuts is a confidence booster. It is risk management. It's proactive. It's insurance. It's not treating, a condition that's worsening every day in terms of the economy. So I don't know how much the market right now is hinging on all that, to be honest with you. I mean, we've been range bound for a year and a half. 2,800 is the level we traded at the day after Election Day. 2,800 is the level we traded at back last spring. So I don't think it's all about the Fed, but what's interesting today is you would have thought the market could have taken this slightly negative news about the Mexico talks today, that they're not going to have an agreement today, as an excuse to say, wow, this was the head fake rally, we're going to sell it off. Who knows? The day is young. We're not through yet.
Futures
we'll see how it
turn
goes.
negative.
What should we be making of falling commodity prices along with a 10-year yield that's right around the lows that we haven't seen in quite some time? I mean, I know it means that people think perhaps we're slowing. You interviewed Abney yesterday, the CEO of UPS. They do, what was it, 6% of world GDP? He seemed to be
US, 3%
pretty positive.
He was surprisingly positive, but is worried about the trade conflicts. I think he's trying to tell investors that they've overreacted in his stock, which, as you know, the Dow transports have been hit harder than the rest of the market, and so has his. He says we've got the flexibility and we can deal with it. So, yes, he sounded optimistic.
But you think more of a message there than, I mean, although it is, again, there is that tension in terms of how strong. I mean, Barry, to you, how strong is the U.S. economy right now from where we've been?
When you look at the thing that we follow most closely because it correlates with earnings is nominal GDP. And it peaked a few quarters ago at 5.5% year-over-year growth. We have it dropping all the way to 3%. I mean, to put that in perspective, 2.5% is a nominal recession. Every recession since Ronald Reagan's first inauguration was at about 2.5% nominal growth year over year at the bottom. So we're going to get pretty close to a nominal recession, we think, by the end of this year, beginning of next year. And as a consequence, that's why the Fed's going to cut. One thing I'd say, though, is here we are at 75 basis points real rates, and the Fed's entertaining a cut. 1.8 is the post-1979 average for real rates. It's pathetic that the market's caught on a hamster wheel of needing free money to stay aloft, and that's really why the PE multiple has stayed up here.